Welcome back to the Wall Street Podcast. Today we're doing a deep dive into a recent analysis from Goldman Sachs. They published their Tianqi Lithium 9696.HK earnings review just recently on August 31st, 2025. In essence, the report flags Tianqi Lithium's first half 2025 earnings. They came in below estimates. Seems primarily due to higher minority interest. This led Goldman to stick with a sell rating. But interestingly, they did adjust target prices upwards while still expressing caution on the lithium price outlook. So let's unpack these key findings, starting with Tianqi's 1H25 performance and how Goldman revised their earnings forecasts.
Right. So Tianqi reported a 1H25 net profit of RMB 87 million. That's an EPS of about RMB 0.053 per share. And that is pretty significant improvement from the RMB 5.2 billion net loss they had back in 1H24. Their recurring net loss also got better. It was RMB 209 million, down from over RMB 3 billion. But as you said, these results did fall below estimates, and the main reason cited was higher than expected minority interests. These are essentially, the profit portions that go to other owners in Tianqi's joint ventures. Think Windfield. It reduces the profit attributable back to Tianqi's main shareholders.
That's a really crucial point. So even with operational gains, those minority interests definitely dragged down the final number. And Goldman reacted by revising down their earnings estimates quite a bit, didn't they? By 6 to 48% for 2025 to 2027. Although it wasn't all negative in the revision, it seems it was partly offset.
That's right. It was partly offset by Goldman actually increasing their gross profit estimates for both the lithium ore and the lithium compound segments. That seems to be driven by expectations of higher sales volumes on one hand and lower unit costs on the other. So some operational positives were recognized.
Okay, so we have this mixed picture. Improved gross profits in the core segments, but an overall earnings miss because of those interests. What's the core takeaway, then, from Goldman's perspective on Tianqi's financial health in the first half?
Well, what's really quite fascinating here is you see these positive trends, gross profit improving for ore and compounds showing operational efficiency gains, but the impact from those higher minority interests, specifically from places like Windfield and also lower losses booked in TLA, they just substantially diluted the net profit figure. It really underscores, I think, the complexities of their structure and how profit allocation significantly affects the reported earnings, maybe masking some underlying operational strength.
Moving to the market outlook, the report mentions potential price support, maybe from supply disruptions in China, but it also flags downside risk from, global excess capacity in lithium. How should investors read these seemingly conflicting signals on pricing?
Yeah, that's a key tension. If you connect it to the bigger picture, you're seeing these dual forces. So sure, immediate regional supply issues, maybe some environmental crackdowns in China, they can offer temporary support for spot prices. We've seen that. But the overarching sort of intrinsic issue is this global excess capacity. It suggests fundamental downward pressure remains. And Goldman's view seems clear here. They see the current spot price, which, yes, is up about 39% from its June bottom, as still having significant downside risk because of that global oversupply picture.
Right, which brings us to another interesting point you flagged earlier. Goldman keeps the sell rating on Tianqi shares, both H and A shares, yet they revise their 12-month target prices up. How do we reconcile that for our listeners? It sounds contradictory.
It does seem counterintuitive at first glance, but it boils down to their valuation methodology. The target price increase to HK $21.50 and RMB 23.0, that's driven by what they call a higher bottom of the cycle valuation. Essentially, their model is now assuming a slightly higher trough level for lithium prices going forward. It incorporates the recent higher spot prices into its longer-term view, even at the low point of the cycle. However, and this is the key point, the current share price, around HA $40.70 for H shares, RMB 44 for A shares, is still substantially higher than even these revised targets. So the implication is still a significant downside, about 47% at current levels, and that justifies maintaining the sell rate despite bumping up the target price itself.
Okay, that clarifies the valuation aspect. Goldman also mentioned several key risks, things like lithium prices, project execution, costs, EV policy.
Right, also overseas asset currency and country risks. Pretty standard list for a global materials company.
So, stepping back from the financials for a moment, how do these insights from a Goldman report on one lithium producer, how does this translate to the broader public? What's the impact on, daily life?
Well, it connects quite directly, actually. The reports focus on lithium price volatility, the global supply dynamics, the influence of government EV policies. All these factors directly affect the cost of electric vehicles. So higher or more volatile lithium prices could mean more expensive EVs or slower price reductions. This, in turn, influences consumer decisions about buying an EV, and it impacts the overall pace of the global energy transition. So it really shows how corporate performance in a key commodity sector like lithium has these tangible ripple effects for everyone. It affects what cars cost and how quickly we shift towards cleaner energy.
A very clear connection. So this deep dive into Goldman's Tianqi report really offers critical insights, not just for investors, but for anyone watching the EV space and the energy transition. As global capacity keeps building and EV adoption rates fluctuate, what further implications might we see down the road for these resource companies and the industries relying on them? Something for you to consider.